Good morning. Welcome to the latest of our regular client webinars. Today, breaking a bit from our trend of doing investment-focused webinars, we're going to be focusing on the topic of estate planning and discussing some of the potential inheritance tax mitigation strategies there are out there. This is in response to sort of feedback from previous webinars that suggested that this would be of interest, and I'd draw your attention to the survey at the end of this webinar to provide such feedback again, and indeed suggest any other topics you'd like to hear from us. So looking at inheritance tax and estate planning is quite a big issue. It can often take sort of years, if not decades, to plan and successfully implement effective intergenerational wealth transition strategies. So today is definitely not going to give you any silver bullets to solve any IHT planning issues, but we hope to be able to showcase some of the types of ideas and solutions there are out there on the market to support discussions that you might have with your wealth managers both now and in the future. Here's the brief running order for today. I'm joined on a call by my colleague Andrew Morley, who's going to provide an initial high-level overview of inheritance tax basics. We then hand over to our first guest presenter, who is Brian Radbone of Transact. He's the head of technical services at Transact, who are one of the UK's biggest, in our eyes, best platforms out there for administering clients' portfolios. Brian's going to talk through some of the effective investment-based trust solutions that are available out there to use. Our second guest speaker caused a bit of a stir in the marketing department when I announced that Tom Hardy was lined up as a guest speaker. Thankfully, the enthusiasm wasn't quelled when our marketing team found out it was the time investments iteration of Tom rather than that of Peaky Blinders and Hollywood fame. So Tom's going to talk through some of the opportunities in the area of business relief, not only for effective estate planning, but also investment diversification. As ever, we'd ask you to use the Q&A function in Zoom to submit any questions you have, and we'll either take them as we go or at the end of the session. If we don't have time, we'll come back to you afterwards. And of course, if you wish to discuss anything specific to your own circumstances, please just get in touch with your usual wealth manager contact. So without further ado, I'll hand over to Andrew to take you through a high-level introduction to the inheritance tax basics.
Thank you, Henry. Morning, everybody. Just as Henry says, I'm just going to be providing basics in terms of the estate planning, just give an overview of what's available to individuals. There's lots of details behind inheritance tax planning. Every individual case is different. And so, but this gives you an idea of where the starting points are with a lot of things. So the basics in terms of estate planning, what we've got is you've got transfers between spouses that are exempt from inheritance tax. So on the passing of one partner, if the assets are passed across to another partner, there's no inheritance tax from that point of view. Also, every individual has a nil rate band of 325,000 available for a family to offset against an estate. And that in the last few years has been increased slightly by the introduction of the residence nil rate band. So giving an additional £175,000 or up to £175,000 each. Based on sort of values of properties, but we have to be mindful with that one is that estates over £2 million, the value of that starts to taper and disappears completely at 2.7 million, and then you're back to, as a joint couple, down to having a £650,000 estate that's then subject to inheritance tax above that, rather than if you retain the residence nil rate band. Then, as you can see there, as a couple, you can then sort of have up to £1 million before the estate is then assessed for inheritance tax. In terms of inheritance tax itself, most people know that any excess above the nil rate bands that are available to the estate, the tax will be paid at 40%. There are some sort of exclusions or are some sort of benefits in terms of looking at maybe charitable gifting around estates within wills. If somebody leaves 10% of their estate to charity, then the inheritance tax band comes down to 36%, and also the charitable gifts are exempt from inheritance tax as well. So there's a little bit of planning that can be done if people want to gift monies across to charities. And just to confirm, in the previous budget last year, We saw that a lot of the allowances have been frozen. So the nil rate band, well, has been frozen since 2009. So actually for quite a long time, and will continue to be frozen until 2026. The resident nil rate band, that was increased slightly over 3 or 4 years to get up to the 175,000. But again, that's going to be frozen until 2026. Government revenue expect to raise around about £1 billion in that the period between 2021 and 26, which is obviously a big tax take. And we always say with inheritance tax planning, to a large degree, paying the tax is actually voluntary, not necessarily a requirement, and it just needs careful planning. If we move on to the next slide, just gives you an example of what actually happens with the tax, and just a sort of brief calculation there. So you've got an available nil rate band there on an estate of £1.5 million, of £650,000, with the residence nil rate band of £350,000, leaving a net estate, taxable estate of £500,000, meaning that there's a tax liability of £200,000. So not small money. And when you think in terms of house values and how they've increased over the last few years, and also asset values generally, it can be quite sort of quick for people to move into those sorts of brackets. Now, as I mentioned previously, you can, as you get above the £2 million estate value, you start to taper down the residence nil rate band that's available to people. So again, on the second example there, the £3 million, the residence nil rate band comes in at 650. Oh, sorry, the nil rate band comes in at 650,000. The residence nil rate band is lost, and then the taxable estate comes in at 2.35 million. You've then got tax payable at 40% on that of £940,000. So it shows how important, planning can be in terms of helping to potentially sort of reduce the inheritance tax liability that can be on estates. And that's something that will be covered off sort of as we go through the presentation. There are things that you can do in the short term, and again, sort of basic examples here. So I've mentioned before about charitable gifting within wills, and reducing down the sort of percentage that is paid on inheritance tax if up to 10% of the estate is left. There's also annual exemptions that you can gift as well. So husband and wife have annual exemptions of £3,000 each that they can gift across to children. So £6,000 in a year for a couple. And you have the £250 sort of unlimited number of £250 that you can pass across to other people. One of the things that is sort of quite often sort of pushed to one side is gifting from excess income. You have to keep records so that the revenue are aware that that's what's been happening in terms of gifting. But as for example, if somebody's got income of £30,000 a year, but they actually only need or spend £20,000 a year, then there's a reason to believe that they could give away the £10,000 without that creating an inheritance tax issue. So again, it's worthwhile considering. There's also the opportunity to gift, so potentially exempt transfers, gifting money outright, sort of after 7 years, it falls outside of the estate. And then we always sort of consider as well pension funding for people, because as it stands at the moment, any pension funding that people make can generally falls outside of the estate straight away as soon as it's made. So again, it's a good form of planning for people going forward. And as it stands at the moment, pension funds don't come back into the estate in terms of calculations for inheritance tax. There's also, and again, this will be discussed further by Brian and to some degree Tom, in terms of the business relief with Tom and the use of trusts. That'll be discussed in a little bit more detail with Brian shortly. And the business relief part as well, there's also exemptions that you can use that allow you to sort of move money outside of the estate within or after a 2-year period, rather than having the sort of longer period of 7 years, depending on what people are looking at in terms of investments and risk profiles. And also as well, finally, people can look to insure the liability. So if all else fails and there's large assets that can't be moved, or they mainly property investments, then you can also insure it. But of course, that needs to be underwritten, and health comes into consideration in that regards. So like I say, that's the basics in terms of where we are with inheritance tax at the moment, and a few of the reliefs that are actually available. I'm now going to pass over to Brian Radbone at Transact, who's now going to go through some of the technical information.
Thank you, Andrew, and good morning, everybody. Yes, I just want to follow up on one of the points really that Andrew was talking about there, and the whole world of sort of inheritance planning. I often do a session called "How hard can it be?" Well, it's very hard, and if you're in the position, a good position of having accumulated a good deal of wealth during life to provide for later life, etc., then one of the big challenges is passing that on to the next generations. And keeping it away from the tax man as much as possible, because by and large you've already paid tax on it and don't want to pay any more on it. So setting up a strategy is a very important thing. And what I want to look at, if we move on to the next slide, is a challenge to a lot of people, I think, is getting underway with this planning. Andrew was talking about, well, yes, you can insure any sort of liability there, but actually starting to move monies away from yourself to other people is a good thing to do. There are many ways to do it. Tom's going to be speaking later about another way of doing it. I'm focusing here on sort of trust planning. And I think people are often reticent to sort of get underway because there's this fear that once you've given something away, that's it. I can't touch it now because the rules don't allow me to. If we move on to the next slide, we'll talk about why that is. The first point, this gift with reservation legislation, which we've had for a number of years now. So if you give something away, and then at some point you think, well, actually, I still need access to it, that's a problem. It comes back into your estate. So you've undone any planning you might have thought was worthwhile. So the problem is that's going to put a lot of people off, understandably, thinking, well, if I can't, I might need to have additional income to my pension, whatever. And once I've given this stuff away, I can't access it anymore. What can I do about it? Well, the good news is there's a few quite interesting mechanisms, if I can call them that, that still enable you to have access without breaking those inheritance tax rules. So you don't have to give it away straight away and lose it. It's gone over the horizon and there's nothing you can do. What you can actually say is, well, what I want to do or have the possibility of doing is to top up my other income, have this future stream of regular payments, as it says here, which are obviously going to come back into my estate over time. That is something that is possible. Moving on to the next point. We'll see that there's a number of ways of doing this, and they have varying degrees of access and IHT efficiency. You'll see as we go through, there's a trade-off between the various types. This first and probably the oldest of the three I'm going to look at is something called gift and loan, or now just loan trusts. So what you're effectively doing is saying, well, I'm not actually going to give a great deal away, maybe only a nominal amount, and the rest of it I'm going to loan to the trustees. And in fact, in more recent times, HMRC kindly said, well, in fact, you don't actually need to give anything away to make one of these trusts work. It can be 100% loan if you want it to be. But what happens is you either set the loan up or you have an initial gift and then add a loan onto that to the trustees, and thereby giving yourself access to that money over time. But just to go through some of the sort of, I won't call it boring because it's technical and I find that interesting, some of the detail here. You can do this in one of two ways, broadly speaking. When you're making the gift or establishing the trust, you can either do it on what we call a bare trust or absolute basis. So effectively, you're making an outright gift, a potentially exempt transfer, as Andrew referred to in the previous situation, out of your estate after 7 years. However, you've got no control of that. Those beneficiaries are set up at outset. They will be the people that eventually benefit. Versus doing it on a what we call discretionary basis, discretionary trust basis, where you're still giving it away, but you're giving it to some trustees who hold it in the trust. And at some point in the future, they'll decide, obviously with your guidance through a letter of wishes, how that money is to be paid, to who, when, and how. So that's just two ways you can do this. And as I say, it's all about how much control do you want to keep. Having given the money away, you don't necessarily have to lose total control. Going back to the gift and loan situation, so immediately, hopefully you're going to get growth on the investment that's made with the money that's been put into the trust. That's immediately outside the estate. And to the extent that there was a gift in the first place, that goes outside of your estate after 7 years. So you've started the ball rolling in terms of moving that money on. So moving on to the next slide. What actually happens? You've made this loan to the trustees, and you can say, well, at any time, what I'd like, please, is to take some money back. Now, typically, you'll see these set up with a regular income and I use the word income in inverted commas because, as we'll see in a minute, is actually, from a tax point of view, not true income. But you take these payments, this income back normally on a regular basis, but you don't have to. You can take it back in slugs, or you can leave it for a while. It's not rigid, it's not fixed at outset. But as I say, typically you do see it done on a regular basis. And over time, that will come back to you. And to the extent that there's any of that loan not paid back by the time you pass away, then it's still yours. It's a loan you made, it comes back into your estate, and therefore will count against your nil rate band along with your other assets. And the trustees do have to repay it, although you could, in your will, have written something to say, well, if that should happen, if there's any amount of loan outstanding, could you move it, pass it to another entity, and they can effectively take the loan on from that point under the same terms that you were enjoying the loan. And there are other things you can do with the loan, which is probably for another day. So while it's a really good structure, it's not a particularly rigid structure, but at least you're starting to sort of make the gifting in terms of the growth anyway, and getting some degree of gift outside of your estate if you've used a gift. So this is a sort of a good start, if you like, in terms of flexibility and still having a large degree of access to your funds. But moving on to the next slide, I'm now coming on to something which is a lot more rigid in structure, the discounted gift trust. And again, in the trade-off, you'll see here, well, the flexibility of this is much less. It's very much sort of set in stone at outset. However, the IHT efficiency of such a plan as this is very efficient indeed. And there's two parts to it really. The first one is you as the settler, the person making the gift, within this mechanism is saying, right, I'm setting up a right to income for myself for the rest of my life from this trust. So the trustees must make sure that you get paid an amount which is stipulated in the trust deed, and that must be adhered to on the frequency and the amount that's put down. As I say, it's stated in the trust deed. Typically, it's a level amount you'll find in most trust deeds, although it can escalate, and some people do that. Some of the providers provide deeds with an escalation option, or indeed an ability not to have the income straight away, but to have it start at some point in the future. But what is essential is that whether it's level or whether it's escalating or whether it's deferred, the precise details of those escalations and deferrals have to be known and locked in at outset. It's not something you can say, well, I could start now, but actually, no, I won't. I'll start in 5 years. No, you will definitely start in 5 years. And the reason for that is because you've got a discount coming into play here with the amount that you're gifting. And one of the main factors in determining that discount is, well, how long are you going to receive the income for over the period of your your life expectancy. Therefore, there's a value to that, and that gives rise to the discount. And as we saw with the previous the loan trust example, you can have this on a either outright gift basis, a potentially exempt transfer, or you can have a bit more control. It can go into a discretionary trust with the trustees deciding later on down the line once you've gone, because of course the overriding concern for the trustees is to make sure you get your income payments. But once you've passed on, then they distribute the trust in accordance with your letter of wishes. So moving on, what we tend to see happens here is that the discount, this is the sort of the big IHT win, if you like, from a discounted gift trust. So you're looking at, well, how old are you when you take this out? Your state of health is clearly important, because whatever age you are can be modified by your current state of health and affects your life expectancy. And how much is it that you're going to want to take? Those three factors sort of get it put into a calculation engine, which as providers we all have, and out will come a discount. Now, a key thing here from HMRC's point of view is that you don't just make it up. So I'm entitled to a 50% discount because I'm such and such an age, and that's fine. And HMRC might well say that if you didn't last very long, in other words, you died very soon after setting the DGT up, they would come along and say, well, I want proof that you can justify that discount, which is why before these are set up, you should be underwritten, should the worst happen. And the worst in my example here is, and I've gone to extremes here, Andrew was mentioning earlier, you've got your 325,000 nil rate band, so you could sort of go the whole hog here and say, well, what's the maximum I can do? You go through the calculation process to determine the discount and find you get a 50% discount. So technically you can put 650,000 in, but it's only treated for IHT purposes as 325,000, and that's all well and good. But if you didn't get it underwritten, and unfortunately death occurred fairly quickly, this is a fairly large gift, HMRC might come along to the provider and say, was there any underwriting done here? And if the answer was no, then they're highly likely to challenge it. And if the worst happened and they said, right, we're just going to ignore the discount, that's a full £650,000 gift, which is clearly 325,000 over your nil rate band, you've suddenly got a tax charge, a hefty IHT 40% tax charge on that excess. So it's very important that the underwriting is done. If health is such that you can't get an underwriting decision leading to a discount, okay, it's not as good, because clearly you want to have the discount in place, but it doesn't mean the trust can't proceed, because the other thing it does, of course, is provide you with this regular income, which is the other thing that you've wanted to do. So moving on, this is just a sort of by way of an aside, but I think it's important. Both the mechanisms I've looked at thus far, I believe to have been designed when they were done really around the whole investment bond situation. Investment bond being, without trying to sound too boring, is a life or capital redemption insurance policy. And because of that, it's subject to income tax only on you as the investor. So capital gains tax doesn't come into it. And it has a mechanism within it which enables tax efficient withdrawals to be made. So one of the things about life company taxation for policies of this type is that you can have up to 5% of the original amount you invest each year for 20 years without paying tax. It's not quite tax free. It's free at the point you receive it. What happens is it gets deferred up until the policy is sort of terminated at some point in the future. But in an ongoing basis, in providing the income we've been looking at from both the loan and the discounted gift trust, you can take up to 5% a year of the amount invested, and that will come out to you as effectively tax-free. But the other point to specify here is an investment bond is a non-income producing asset. So actually, when you're taking these withdrawals from the bond, you're not taking income from an income tax perspective, you're taking capital. So it doesn't count as taxable income when it comes to you. It's just a capital repayment of the investment you've made. Just a quick note on who pays the tax, a bit technical, but it's probably important. I've talked about the two ways of doing the trust, either the outright gift or the more control-based discretionary trust. With the bare trust, typically the beneficiaries will be the taxable entities. So if you do get a tax charge on the investment bond because you exceed the 5% per annum, which is unlikely, but in the end, when the distributions happened and the bond is finally terminated, the chargeable gain will arise. Then in the case of the bare trust version, it's the beneficiaries that pay the tax on that, not the trustees or not you. With a discretionary trust, it's quite different. And if a gain arises while you're still alive as the settler, or in fact in the tax year that you die, it actually gets assessed on you as the settler at your income tax rates. You can then go to the trustees if you're still alive and get the money back, or your personal representatives can. But in any following tax year where a chargeable gain arises, which is more likely to be the case, then it is the trustees that are liable for the taxation. And this leads on really to quite an efficient point with investment bonds as life policies. To avoid that happening and the messiness of it happening inside the trust and the trustees having to deal with tax, because trustees do pay tax at the highest rate, you can actually assign, because investment bonds are subdivided into identical policies. So you could say, well, I've got a couple of beneficiaries here. We've got an investment bond with 100 of these individual policies. We now want to distribute the benefits. Let's just move 50 of the segments to beneficiary 1 and 50 of the segments to beneficiary 2. They then surrender them, terminate them, and it becomes their tax issue at their tax rates. So it's another one of the advantages of investment bonds and why they're fit for purpose really when it comes to this type of planning mechanism using these types of trusts. On to the next slide. This is just a sort of a bit of middle ground. I've left this till the end because we don't offer these. We do the discounted gift and the gift and loan trust. Flexible reversionary trust is another take on this, where if you think about it, you've got a series of fixed term policies coming at you on a conveyor belt, and as they drop off, that's effectively the income you're wanting. But you have the choice to say, well, actually, I don't want that. Can you send it back up the conveyor belt and it can come along later on? In the meantime, the trustees, if they want to provide stuff for the beneficiaries, they can do by surrendering the appropriate number of policies. And again, this is a chargeable transfer. So payment into a discretion, it's a discretionary side of your estate after 7 years, but you don't get a discount with this one because of this use the income under a discounted reason for the discount. So next slide, please. The three versions here. Oh, there we go. So just to sum up, really, it is possible. You can give money away, but it's not quite as frightening as you think. There are still mechanisms that allow you to have access. So don't let it put you off. And we've looked at three of them, and I've kind of put them there in a diagram because, you know, somebody used to say to me many years ago, if in doubt, draw a diagram. And this gives you the sort of trade-off between the accessibility and the IHT efficiency. So if you want a flexible type of access, take as little or as much as you want when you want, then the gift and loan, the loan trust provides the best way of doing that. It's not quite as IHT efficient because you're not moving so much money out of your estate at the start. At the other end of the scale, the discounted gift trust, you can move quite a lot out because of the discount. But the quid pro quo, if you like, is you must take the income specified in the trust deed, otherwise the trust fails. And in the middle there, just in the middle ground, is that flexible reversionary trust. So that's really all I wanted to say today. I think there's one more slide that we have to show you. Thanks very much for listening. That's the all-important compliance slide, which I'm afraid I have to show you. But I'll just hand over from here. But thank you very much for listening.
Thanks, Brian. I think we had a slight audio issue with the flexible reversionary trust slide. Whether that's deliberate because Transact don't offer it or not, I'll pick up with you later on. But obviously, if anyone else had some issues with that small part of the presentation, then very much just bring it up with your wealth manager contacts, and they can talk you through those solutions. Just speaking from personal experience, I've seen all three of those different iterations in work and in practice live with clients, and all three, can be really effective. The suitability of them, of course, is dependent on the client's circumstances. And again, that's something that, our advisors will be able to work with clients to sort of help establish. So just moving on, I'd like to hand over now to Tom. Tom, as I said earlier, is from Time Investments. It's one of the companies we use quite often with clients when we're considering business relief. So Tom's going to take you through the basics of that, both from a legislation point of view, a tax position, and also an investment position. So over to you, Tom.
Nice one. Thank you, Henry. Morning, everyone. Yes, taking a break, very short break from my holiday career today to talk to you about business relief and what we do at Time, which is managing investments that qualify for business relief, or BR or BPR as it used to be known, and how that can be an effective way to help gain exemption from inheritance tax. So firstly, I think I'd like to get the compliance bit out of the way first. So yeah, just have to kind of show you this. Just the key points to bring out from you here is that anything in this presentation, it doesn't constitute tax advice, and it's based on our current interpretation of tax legislation, which obviously is subject to change. But yes, it's there for you to read at your leisure. So yeah, in terms of what I'm going to try and cover in the next sort of 10-15 minutes or so, is a quick look back at the IHT landscape, so just building on what Andrew said a little while ago, and then to cover through what business relief is, the background to that, what we do at Time, which uses business relief to help with IHT planning, and then a little bit about the types of investments that we make that qualify for business relief, and some of the positive impacts that they also have as well. So yeah, firstly, just to kind of build on what Andrew was saying around the inheritance tax landscape, this first chart here as you can see, there's this rapid rise in IHT receipts over the last decade or so, from 2.7 billion 10 years ago, 11 years ago, to where we are over the last couple of years, where it's been above 5 billion. And there's a couple of reasons for this. Firstly, as we mentioned before, the nil rate band has been the same since 2010, 2011, and will be static until 2026 based on Rishi's latest update on it. But secondly, asset prices and house prices have increased hugely over this period as well, and with people's homes being most people's main asset. I think it varies a lot based on regions, but if you look at UK average house prices over the last decade or so, they've increased by sort of 45 to 50%. So where those nil rate bands have been static, it's really been pushing more and more people into IHT paying territory. And investment portfolios over that period have also grown, quite largely as well. So a combination of increased estate values, along with those frozen nil rate bands, along with the fact that we've got the pensions lifetime allowance being frozen, limiting how much you can put into your pension, it's all combining to increase the government take from IHT. The next chart is also quite interesting because it breaks down where IHT is being paid based on different UK regions. No surprise that London and the South West have both the highest number of estates that are paying IHT and the highest total value when you consider things like house prices in those regions. So I think the highest average IHT bill was London. This is data based on 2018-19, which was 270 odd thousand average IHT bill, and I think the lowest was Wales, about 155. But interestingly, the East and East Anglia was joint third, roughly, with about 2,500 estates paying on average about 200k in IHT. So not insignificant amount of tax being paid there. So we've had some background from what IHT is and who's paying it, but on this slide again, just kind of building on Andrew's comments, these are some of the options that you have to help reduce your IHT liability. I think looking at the first one, an often referenced quote when it comes to inheritance tax comes from the ex-Chancellor Roy Jenkins from many moons ago, who said inheritance tax is a voluntary levy paid by those who distrust their heirs more than they dislike the inland revenue. I think that's very true. One of the most effective ways to avoid paying inheritance tax is to give money away. But there's obviously many other options that you, working with your SG Wealth financial advisor, have at your disposal. I think Brian's talked about many benefits of utilising different types of trusts, but there are other options there, and one that I think is worth building on is looking at business relief. So, what is business relief? Well, it's a piece of legislation that was originally brought in around 40 plus years ago in the 1976 Finance Act. Its main aim was to ensure that after the death of the owner, a family-owned business could survive as a trading entity without having to be sold or broken up to pay an IHT liability. So over time, it's been supported by successive governments and recognised the value of encouraging people to not only not have to break up those businesses, but support investment into trading businesses regardless of whether they run those businesses themselves. So business relief was broadened out and the scope was broadened out, and the fact that it was established 40 years ago, very well supported and supports the family business sector in the UK, which employs, based on our latest analysis, about 14 million people. So the rules are very simple. If someone owns a business relief qualifying share and they own them for 2 years, they can be 100% free from IHT. The rules are that someone has to own them for 2 out of the previous 5 years, and they must be held on death of the owner. That 2-year ownership period is transferable between spouses, which is important to know as well. So husband owns or purchases business relief qualifying shares, owns them for a year and passes away. when they're inherited by his spouse, they'd only have to wait for one further year for that to be 100% free from IHT, which is a nice kind of benefit. You don't have to own shares in your own business. The rules, as I said, have evolved over time to include private investors who are investing in qualifying businesses. So why is business relief such an effective tool when it comes to estate planning? We've listed some of the main reasons that we get why people use services such as ours here. By far the most common reason, the most attractive reason we find when we ask people is access. So, as you're purchasing shares in a qualifying business, you retain access to that capital should you need it in the future or should your circumstances change. A huge concern for people is being able to provide for things and unknowable things in the future, such as care home fees, which can be very, very expensive. And in some circumstances, giving that capital away might be unattractive due to potentially needing access to it later down the line. And investing in something like business relief does help with that issue. Another attractive feature is the swiftness of it, and the swiftness of the 2-year rule when compared to a kind of 7-year look back rule when making gifts or utilising certain trusts. So we do often see business relief being used for older clients or clients with health complications where the concern is they might not survive the full 7-year look back kind of period for other planning. It's very simple and easy to understand, and unlike when looking at other options such as the insurance or life assurance versions, there's no medical or kind of age restriction things to factor into the planning. It is an investment that you're making, and on that point, finding that there are a range of different investment options to look at. It's a very developed market. There's lots of different ways that you can get access to business relief, which moves on to my next slide, which is some of the ways that you can get access to it. 4 main ways you can do it. You can obviously run your own qualifying trading business. Many people running businesses for many years, and owning those shares on death will be, depending on the trading activity, will be BR qualifying. You can also buy shares of companies that trade on the alternatives investment market, so AIM, which you may well have heard of. And since 2013, the rules changed to also allow you to purchase AIM shares within an ISA, so making an already very nice tax efficient wrapper even more tax effective by bringing in IHT relief into the ISA as well. On the bottom right, you can buy shares in an enterprise investment scheme. There might be other considerations when looking at EISs because they have other income tax and capital gains tax benefits as well. Or you can invest in what we'd call an asset-backed business relief service. These are services which give investors access to unquoted companies that invest into a range of different sectors, and there's a lot of different options here as well. And this is one of the areas that we specialise in at Time. So I'll give you a little bit of background to Time as a company now. So we've been around since 2013, but the founders of Time were a previous company running IHT services since 1996. So we've got a very long track record of managing investments in this area. We look after as a company about 4.5 billion, of which 1 billion is in business relief qualifying assets. And we've won a few industry awards along the way, which is nice. On the next slide, it's showing a few details about what we'd call our asset-backed business relief service, and I'll kind of show you what we mean by asset backing. But this service has been around since 2013. It's got a very long track record of this type of service in this industry. It looks after currently about 850 million, I think just above that, for about 5,500 investors. And it has a very transparent investment strategy that we're trying to target between 3 to 4.5% per annum, on top of the benefit of holding shares in this service for 2 years and it being IHT efficient. So to look at some of the investments that we make within the portfolio, here's a snapshot of some of the areas that we invest into. Many of these have traits that we like in terms of being asset-backed businesses based in the UK that target, suitable returns for what we're looking for from the service. Around 74%, I think, at the moment of the portfolio is invested into renewable energy assets in the UK, and that covers a few areas. It's mainly wind and solar, but we do have a smaller allocation to areas such as hydro and biomass. And why do we like these sectors? They are tangible assets which themselves have a related value, and we also get a strong amount of support from the government through some of the renewable energy subsidies, which provide security to their income stream when the assets themselves might not be generating as much energy. There's still that support from the subsidy. There's a really strong demand for these types of assets in the market, which does help provide liquidity should we need to access it. And they're seasonally complementary as well. We've got the wind and solar part, which makes up the bulk of our renewable exposure. They provide a really nice balance through this very changeable weather system that we have in the UK. And I found out recently that the UK is actually, or Scotland specifically, is the windiest country in Europe. So, very good kind of potential for energy generation from particularly the wind assets. We also have other trades, as denoted by the pictures here, that acts as a diversifier within the portfolio, such as property lending. Here we're lending to developers who are looking to finance projects in desirable locations across the UK, but there is a real kind of London, South East, South West kind of tilt towards it because of the desirability and the market there. But we get returns here through both the interest payments and also the contracted fees on each loan that we're setting up. We mitigate risks here by having the loan secured against the properties on a first charge basis. And we also mitigate risk by capping the maximum of any loan that we offer up to 65% of the total market value of the property. So trying to be as risk averse in this market as we can and getting those steady kind of predictable income streams. Forestry is another asset that we like here. A smaller part of the portfolio, I think, is currently maybe at 6 or 7%. We like it. It's another asset-backed, land-backed asset. And there's potential here for capital appreciation from the increasing volume of the timber that we're producing as the crops grow, but also the value of the land. We are living on an island, and there's a high demand for land and for forestry plantations in this country, which are relatively scarce. So, which again helps provide liquidity in the portfolio. And then finally, we're fairly unique in this space in that we're one of the few BR managers, business relief managers, that use self-storage within our portfolios. Again, it's a smaller allocation, probably around 6-7% at the moment, but it's another tangible asset-backed business that you can invest into. Consistent income returns from the rental of the units that we own within the self-storage locations, but also the capital appreciation we get from the building itself. So nice fit with what we're trying to achieve in the service that we're offering. On the next slide is I'm just conscious of time, so I'll wrap up shortly, but here's a map of the UK showing where our assets are spread. The wind farms, as you can imagine, tend to be coastal and lots in Scotland. And the solar parks we run, not surprisingly, mainly located in the sunnier regions of the country in the southwest. I think it's interesting to point out to investors who are using this service for the business relief aspect and the IHT planning that they also have the opportunity to directly support renewable energy through these capital commitments, whilst also participating in the profit streams they get from the assets. And these are some of the figures at kind of like a high level in terms of the types of carbon offset on offer from our portfolio, the equivalent amount of trees that would have to be planted for that carbon offset, and that's at the high level. But what we're able to do as well, if you move on to the next slide, is for each investor in our service, because we have the data, we can also measure the impact a specific investment amount has in our portfolio. So here's an example of someone investing 100,000 into our service. The amount of clean energy that generates, the amount of carbon offset is all on we're able to display that. And when you consider the average carbon footprint per person in the UK is estimated at being around 12 tons of CO2 per year, you can see that an investment into a service such as this does a really benefits you in terms of offsetting your own personal carbon production. If you're concerned about that type of thing, it's nice to be able to display it. So, and finally, just a note on, we talked about the predictability and the types of returns that we're trying to target here, between 3 to 4.5% per annum. We have a really strong track record of delivering against that. These are unquoted investments. They don't tend to react to what's going on in financial markets, and as a result are fairly uncorrelated. They have been historically with what's been going on elsewhere. So it's nice to see that kind of consistency and predictability of the income and the performance we're seeing. So that's it from me. Hopefully you found that useful, and I'll hand it back over to Henry.
Great stuff. Yeah, thanks, Tom. I appreciate both yours and Brian's were very much whistle-stop tours of relatively complex, solutions that we use for clients. But I'm sure everyone found the sort of the relatively high-level overview, really interesting, engaging, and of course, as we've said already, to dive into the detail a bit more, we can very much do that on a client-specific basis as we go. We have had a few questions as we've been going. I appreciate everyone's efforts to try and keep this sort of within the allotted time, and I think we're doing okay. So we've got a couple of minutes to take some questions. Whilst you're still on screen, Tom, for me, we did have a question come in specifically around some of the business relief investments, which was very relevant for you with your renewable energy holdings and things. And it was talking about the volatility in energy prices, obviously very, very topical at the moment. But also, from my own sort of knowledge, energy prices have been volatile for some time, both sort of upwards more recently and downwards as well. And the question was really sort of, how does that volatility affect the performance of the sort of investments that you hold, and ultimately the performance that the end client has?
Yeah, no, it's probably the biggest question we get at the moment from people, because it's so pertinent. People are seeing the impact on their what they're paying, their energy bills every month. So it's this is the flip side though. We are generating energy and we are selling it to the grid. So all else being equal, we should see benefit in terms of increase in value to people that have invested in our service, and the income that we're generating from the assets should energy prices continue to increase. With our service though, and we're different to some of the other business relief managers out there, we tend to have fixes on our contracts for the energy prices that we're selling to the grid for a period of time. So, and the reason we do that is to try and mitigate this short-term volatility in the energy markets. Before, what's been happening the last couple of years, energy prices have tended to trend downwards. We're getting more of an influx in energy production, particularly green energy. So it's helped to lock in a certain level of return. More recently, that's trended upwards and we've seen huge increases. And in the short term, we've not seen a similar increase in our returns to coincide with that. I mean, the figure you just saw, it was, I think last year, we generated and we returned about 3.2%. So, largely in line with our target return. Should energy prices be sustained for a period of time in the future, we should see an increase in our return to coincide with that when we start going through the next negotiations of our contracts. But in the short term, we fix things to stop this volatility, essentially.
Great stuff. Thanks for that. Another question that's come in is actually, I think, probably one for Brian. It's on the trust side of things. And I guess the answer is going to depend on what the solution, but I'll hand it over to you. It's about sort of the ability to change one's mind. So the question is, can I change my mind once I've established one of these trusts? So quite an open question, but yeah, do you want to take that one?
Yeah, I mean, the baseline answer is you can't. Once you've given something away, you've given it away. So the trust is established. I suppose there are some instances it can get quite messy and you might end up going to the courts to try and do it, but you really have to take it as read as you can't unwind it. Where you can change each of the ones we've looked at, particularly the DGT and the gift and loan, is you don't, well, we know with the gift and loan, you don't have to take the income. So if you think, well, I don't need it anymore, I'll just give the rest away. But of course, that's the other side of the coin. That's you saying, well, I don't want the money at all now, actually. Can I get rid of it? Yes, you can. It's just another gift at the time you do that. A bit more complex with a discounted gift trust. If you remember it, the trustee gives a figure that has to be paid. That's what it says. There is an option for you to say, I don't really want any more of these regular payments coming back into my estate. I want to get shot of it. The answer is yes, you can do that, but you have to go and find a friendly actuary to do a calculation for you to say, well, if you're going to give these up now, that's worth in today's money X. That's another gift that you're making at that point. So it's not quite as set in stone as I said it was. There is a way out of it, but it'll cost, because you have to get an actuary involved and you probably need to have the trustee looked at by a legal expert. But in terms of the general rule about once you make what you call an irrevocable gift, really, which is what you're doing when you set a trust up, to unwind it is well, near on impossible.
Thanks. And that sort of leads, well, sort of connected to another question we've had, which one maybe I'll direct to Andrew. It says, what if I need access to capital I've gifted for care fees? Now, I think, so Andrew, I don't know if you've got any comments on that, around sort of the planning for that sort of scenario that we could do before setting these sort of things up.
Yeah, I mean, it's obviously it's a good question because it covers both areas in terms of inheritance tax and long-term care, and both in themselves add varying degrees of complications, especially when you're dealing with local authority with care for your assessments and the work around that. In terms of what we would do as financial planning, I think we've seen from the examples that Tom and Brian have sort of set out that there are ways that money can be accessed, through discounted gift and loan trust. The income can be generated. So if they've stopped the income, then that could be sort of paid out so that they're actually getting some money towards care fees. And as Tom mentioned, that with the BR schemes, there is an accessibility bit. You wouldn't want people drawing it all out, because as soon as it comes back into your estate from that point of view, that forms part of the calculation for inheritance tax. So a drip feed of that can be useful. But in fairness, I suppose really the planning starts from an early stage, and looking at how we would work, we'd probably look and consider those options with sort of cash flow modelling and putting together what people's objectives are in terms of retirement and sustainability. And it may be that somebody, I suppose, in their early 70s might decide as a family they want to give away £250,000 as an example. What we can then do is we can factor into the cash flow something that says, okay, you give away £250,000, are you still going to be able to maintain your lifestyle through your retirement, probably up to age 100, by being able to sort of gift that money away? If the answer is yes, then we can look a bit further and say, okay, maybe in the 80s, we've then got a situation where long-term care is required. And so then what we can do is we can add in sort of elements of care needs going on later on, and then seeing again where the sort of sustainability of assets, investments and pensions sort of run up to age 100. So it gives people some sort of indication of how we do it. Again, it's on a case-by-case basis, and everybody's different. Everybody wants different levels of income, and so on and so forth. So it's just a case of looking at it case by case. But cash flow works brilliantly in that respect. It gives some people, it is based on assumptions, but it gives some people a good guide as to whether or not they can give away £250,000, 100,000, £500,000. We can work within all sorts of different parameters around that. So that's the case. Is start the planning as early as possible and look to see when you may be wanting to give those gifts away, and then hopefully that you won't need to access either something from the gift and loan trust or from the business relief schemes, so they can still do their inheritance tax bit from the client's point of view as well.
Yeah, sure. And I think actually whilst yes, every situation is completely unique and can be tailored to meet people's circumstances, I think we'll be releasing a number of sort of case studies to explore some of those different sort of scenarios and look at sort of some of the examples of cash flow modelling over the weeks and months to come. So look out for those as well. One final question before we sort of wrap up. Bit hypothetical, and it's probably one I'd just maybe ask Tom and Brian to comment on. Tom, I'll give you the chance to go first, if you like. Question is around legislation change, and what is the risk that legislation will change in the future to affect these investments? Now that the question, the person who's asked it hasn't been specific as to who they're directing it from, so I'll give you both the chance to answer that, if you may.
Yeah. Okay. So specifically for business relief, it's been around for 40 plus years, and it's remained intact with some changes along the way, positive changes from our point of view. But I think obviously at the moment we're in an environment where the government borrowing's gone through the roof through COVID and lockdowns to kind of prop up businesses and staff, and as a result, focus is moving on to policies that will help to pay that debt off, both in stimulating growth, but also potential tax raises. So business relief kind of straddles both of those. It's an incentive for growth funding in specific areas, but so it's well placed there. But as a tax relief, that cuts government receipts. It's obviously might be less secure there. But I suppose bearing in mind the relatively small costs to the government, I'd say from business relief, I think I looked at this the other day. I think it's about 820 million in 2019-20, and past kind of praise from Conservatives about business relief as a drive for growth. We feel that it's a fairly strong argument that it will kind of remain untouched and it's fairly secure.
Good, thanks. And Brian, from a trust perspective, I guess retrospective legislation change, looking back at trusts, have you got anything to add on that?
Well, I think the mechanisms I talked about earlier are pretty much tried and tested, and HMRC are happy with them and accept them as standard, well thought out planning. There's nothing dicey about them, which there is in some more extreme areas. But we do know that probably, going back, I think 5 years ago, when Theresa May was in charge, I think she asked Philip Hammond, who was then Chancellor, to go off and sort something out about inheritance tax generally, because it is just so complex. I mean, we've only just touched it this morning, but there's all sorts of rules that we're all quite familiar with, which are very complex. So there's a drive to maybe tidy things up, which is a good thing. They started doing that from the paperwork side, because there was this nonsense of loads of people completing paperwork, after somebody had died, for not very many of them to actually end up paying any tax. So why are you wasting the client's time doing it, and also HMRC's time? So there's been moves afoot on that, but then we're waiting really, and this has been stopped by the pandemic, about other areas around the particulars. We've talked about 7 years a lot today, the rolling 7-year thing. Get rid of that, just have a flat 5 years, and then stuff is out of your estate, and you haven't got to worry about cumulative gifts on rolling 7 years and that sort of thing. So I think there's something coming along the track, but to echo really what Tom said, inheritance tax isn't very much in the tax take. I think it's around 5%, if that. So it's not burning a hole. And as we've seen from earlier on, the number of people paying inheritance tax and the amounts are going up all the time. So there is a sense in which the government, I suppose, are a little bit happy anyway about that. The one for me, which is probably the biggest nasty, and it's more a CGT issue, but it does come into the world of planning, I suppose, and we haven't touched on this, is that if you hold assets that are subject to capital gains tax, one of the advantages, if that's the right word, when you die, is that the gains on those assets are rebased to the date of death, which can be quite significant. And there's a lot of rumblings in the reports that have been written, both from the inheritance tax side and also from the CGT side, saying we need to do away with that, this whole rebasing at date of death. And that would be a shame, because that's quite a valuable leg up, if I can call it that, on those assets. So that seems to be the one. If you were to ask me which one are they likely to go for first, that's easy, isn't it, for them? You just turn off that, and sorry, the gain stays in place for the recipient beneficiary.
Yeah, as you say, that would have a sizable impact on a number of people's sort of intergenerational sort of transfer strategies, really, which I guess just alludes to the fact that, you know, once a plan is made, you know, to deal with anything, but estate planning specifically, one needs to keep that under regular review, because there's always multiple moving parts, whether it is legislation or investment, or most specifically the client's needs and objectives. All of those things will change, and all of those things need to be factored into the plan, which will adapt accordingly. Good. Well, I think we've just ticked over the hour. Whilst it's been good fun, and I'd like to thank our speakers for their time and their information, I think we should draw today to a close. Thanks also to everyone who's been on the call. I hope you found it interesting. I'm sure you did. We will be making a replay of this available on the website, so you can refer back to it as well. As I've said numerous times, just go back and speak to your usual contact at SG Wealth as well with any further questions and issues you want to pick up, and to look at this sort of whole area in a bit more detail. Just finally, we'd be very grateful if everyone can complete the feedback questionnaire that will pop up after the call. We really value the feedback. It's very nice to hear what people think and what they want to hear about. So please do take some time to complete that. And that's it. Yeah, we'll be doing our next call again in a month or two's time. Just like to make our thanks again to the speakers and the guests. Hope you enjoy the rest of your day, and look forward to seeing you again soon. Cheers.